La-di-da-di-da. All right, good morning. Happy Monday. Just another manic Monday. It's what, 6:30 in the morning on Wall Street. It's time to get our macro on. Welcome to QuantBox Live, where we uncover the best fundamental investment opportunities across the global markets. My name is Wayne McDonald. I'm the founder of QuantBox, but also a Harvard-trained economist. So I love what we do. Love, love, love. Now, if you're watching this on YouTube, hours and hours and hours and hours and hours has passed. You could have attended this event live instead of watching it at 10 o'clock in the morning. You could be here with us now. You can do a 1-week trial for just $8. Okay. Cover for the $80 a month, US dollar pairs, yen pairs, S&P 500, gold, oil. Yes. So with that being said, let's get on with it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Just an update. The last video for the strategy session is way back on Thursday, June 1st. Where's Friday? Well, on Friday, I did non-farm payrolls live at FX Street. So that's why there's no Friday. Coolio. So anyways, let's log in to the cloud. Make sure you're using the right Gmail account. Let me suck down my 5 shots of espresso. Ooh la la. Good morning. All righty. Let's zoom in. Take a look here. Ooh, that Japanese stock market is on fire. Yeah, very nice. Dow is up. S&P 500 is up. NASDAQ is up. Nothing else. These are up, but not much. These are down, not much. And then Bitcoin is way down, which is odd. So I look at this immediately and say, this doesn't make a lot of sense. This is way right. But, well, no, I should say it the other way. It makes a ton of sense, but they kind of offset each other. See, the way that we're looking at these outliers is that Bitcoin was quantitatively, right? When you do the quantitative scoring that QuantBox does, quantitatively, Bitcoin down makes a ton of sense. Japanese stock market up makes a ton of sense. And those things have happened. But here's the interesting thing. This is typically risk on. This is typically risk off. Which one represents a free market most closely? Well, definitely not the Japanese stock market, because the Central Bank of Japan owns a boatload of their stock. Right? Oh, we got a hot mic. All right, turn mic off. There we go. All right. So anywho, yeah, wow. So this up, but you know, everything is up too. Interesting. These are slightly negative scores, so they're not that far off, but they're up. Okay. So anywho, the Dow and the S&P 500 are the bigger outliers. So again, like if you look at this, QuantBox is giving the Dow a -4, and the Japanese stock market is a big positive number. So anyways, something else is going on there. If you're looking over the last month or so, what you see here is the basic trend, okay, in the stock markets around the world. Does that look like down? No. Okay, so there is a risk on mood here. That's kind of what you want to look at. There has been, at least for the very least, a risk on mood. Cool. All right. So look, pound's still a strong sell. Let's clear up the scatter plot. Let's get rid of the commodities and indices and reset this. And everything doing well over here. Everything doing well. So I think we should do dollar pairs today. Um, Mostly because I want to cover them today because on Friday we had non-farm payrolls. And I explained before the news came out what would happen the if the news came out 200,000, 250,000, 300,000, more than 300,000 in the jobs report. I expected it to come out more than expected. 200,000 was expected. That's why I gave the example of 200, 250, and 300. And why did I expect more? 19 out of the last 20 were higher than expected. Don't have to be a rocket surgeon. Maybe it's going to come out hot. Okay. So, anyways, what I said was if it came out 300 or more, that's going to create US dollar strength. And so, if we see US dollar strength here, and that's what the scatter plot is showing us, then that makes a ton of sense. So, if we like zoom into a dollar pair here, pull up the pig. Okay. Hey, non-farm payrolls is red hot. Remember, the initial response to the news was dollar weakness. Lots of green candles. And I'm like, uh-huh. Dollar weakness, pound dollar was up, euro dollar was up. I'm like, you can have it. I'm not interested. Why? I don't trade the news. I trade quantitatively, which is taking the aggregate of all the news, looking at the trend of news, and then doing comparative analysis between assets. I don't scope the news. So anyway, this would have been up right after non-farm payrolls. Well, it looks like it's down today. Okay. You can see seasonally over the last 20 years, if you're looking in this period here from April, May, June, pound dollar typically falls, and it has fallen, generally speaking. Coolio. So that's a hardcore down score. Wow. Okay. Yet retail is still long. Retail traders, 2/3 of retail traders are long this sucker, right? And it's because they probably don't know over the last 20 years it typically falls this time of year. What they're chasing, because remember, most retail are probably not looking at daily charts like daily candles and weekly candles, right? They're not thinking quarterly, they're thinking the next 2 hours. And so they get caught up in this trend and they don't see the bigger move coming. And most likely they didn't see the uptrend coming either. So, right, they're selling at the bottom and buying at the top, and they're getting a little bit there, but they're losing most. Right, is kind of the guess. But nonetheless, yeah, you can see there is an edge when you look at institutional investing. There is an edge on the dollar, 70% versus 55%. Right, long. Okay. But when you put this together, there's quite a few people short the pound and a ton long the dollar. So it makes sense to the downside. Of course, this is all explained in the output summary. But when you look at interest rates, favors the dollar. Unemployment favors the dollar. Inflation favors the dollar. GDP growth favors the dollar. Technical trend, very bearish, favors the dollar. Seasonality favors the dollar. Retail sentiment favors the dollar. COT, commitment to traders report, which is institutional, favors the dollar. Down. Cool. 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 Let's get off gold here. You pull up the pig, great big pig. So you want to, okay, see that big up move on Friday? Uh-huh. Uh-huh. Like I said, literally as I'm leaving the 3-hour webinar, and the whole time it was up for 3 hours, I'm like, you can have it. I'm not interested. I'm a bear. Goodbye. Boom. Down. Okay. Down the stretch. So no, there's no doubt though, there's up going on here, but knowing things like seasonality, you should be well prepared as a bear for bearish entries if you get them. Remember, it's an if then statement. Okay. It's a new month too. You should be setting up monthlies. If you're not sure how to do technical analysis strategies, you should consider fxbootcamp.com. Okay. But nonetheless, this area here, based on technical analysis, is the best selling prices of the month of June. It doesn't tell you to sell. It tells you if you're a bear, you're going to look for bearishness to appear. Okay. Somewhere in there. And that's the price. So now if you got what you need to say, aha, it bearishness is happening, then you probably want to sell lower highs. And you want to start engaging that way. Okay. It's when you got to make the connection. You got to like click over and say, aha, now it's bearish. Now, you might have been more aggressive up here off the news. Okay. So on and so forth. But nonetheless, this is what you might be looking for the next few days. Probably want to catch that 21. Okay. That 21 looks like it's going to drop below the 55. There's still some challenges now. Now you're very, very, very late. See, I didn't say sell now. I said, if it comes back up, you're going to sell a lower high. The reason you can't sell now is technically speaking, we have now entered the best price for bulls. And a bull that wants to continue the uptrend is going to kick it off of that blue line. Okay. So based on the formula Y equals MX plus B, okay, this is the rise over the run, which we call the mean. That's the M. Okay. Okay. And then what we're looking at is you figure out the variance, which is how far below price does, or how far below the mean does price deviate? Okay. How far above price does it deviate before it reverts to the mean? How far does it deviate before it reverts to the mean? How far does it deviate before it reverts to the mean? It's actually, instead of deviation, we call that variance. Take the square root of the variance and you get the standard deviation. So this bigger move up here pulled this one down. Nonetheless, a mean reversion trade, which is a topic of my new book, is going to be, somebody's going to think that. We don't know if it's right, but we do assume that this is a bad place to sell. Okay. If your assumption is that you're much more fundamental than, like, who cares if it's two standard deviations from the mean? Who cares, right? If this is supposed to be down, it's going to go down. So what you want to do is sell a lower high, and then got the break, right? That actually breaks the trend. Then you'll have a breakout type strategy and you'll continue down. But the issue is, if you're a bear, you want to sell lower highs or double tops. Okay. And definitely not lower lows at support. Definitely not. By the way, is the microphone improved from last night for those boot campers? I want that radio voice. Hello. But it doesn't seem to do it. I might have to get rid of the mic. It's supposed to make me sound taller. Taking a quick, right? Here we go. There is also the trade plan from non-farm payrolls that I did live at FX Street. We were here. Okay. Then there was this giant up. Here's the green candle, by the way. You don't see it anymore. Let me do this a better green. There we go. It was a huge green candle. You see that? Huge series of green candles. And I'm like, nah, not interested. Okay. Because the down, the news created the up, and I'm like, somewhere around here, I'm looking for it to fall, somewhere between the 382 and 618 Fibonacci extension. That's a standard news trading strategy I've been teaching for 20 years. Sorry, for that one webinar, I've only been doing it 17 and a half years. Yeah, only on a monthly basis for 17 and a half years. That idea of the breakout, the pullback, and the continuation. Okay. So up, 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 green candles. If you're a bear, is brilliant. Right as rain. Because I'm a bear, I sell green candles. And that's what that was all about. And came down, and that was a plausible target. Now we're in something called out of position. Okay. So most likely what's happening here is we've dropped low. We're going to move sideways, let that 21 catch up. Then it's going to drop to the next level. So you probably want to box it in here. Okay. And you want to either sell high or you want to sell lower high. Okay. And your target, because it's an out of position trade, let's get a target for you. Okay. First of all, it's out of position on a weekly basis. So that would get us down to about 106. So another 100 pips down. The thing with an out of position trade is not only do you typically hit your target, but you hit your target earlier. So you're like, it's only 100 pips, but we'll probably hit it before Wednesday. And if you are so lucky, then the same analysis says take your profit. Okay, that's all. So that's enough. You can carry that through all the yen pairs. I think another interesting one would be USD yen. Okay. And Coolio. Maybe zoom in on this basis. So now, if you were waiting for a higher high, game on. You have permission to engage. Okay, probably want to kick it off that 21 on the hourly because of the 21.55 cross. It is technically bullish, and if you're fundamentally bullish, you want to buy a dip. What does QB say about this? Invalid metric value. Well, let's try to score it. 1, -1 is 0. Then it's -1, and then it's 0. Oh, it's having trouble with the trend. Well, that's a 2. So let's go back. 1, 0, -1, 0, 2, 3, 4, 5, 6. So that is going to be up because I know the math. Helps to know the math, right? So it's definitely an up. Let me take a screenshot for the developers. They're going to be so happy. Good morning, minions. Good morning, minions. All right. So, anyways, Coolio. So I got that screenshot. Nice. A couple other things I want to look at quickly before we run out of time. I don't want to do gold. I want to do oil. Let's go to a smaller time frame and we zoom in here. Okay, we had a gap. So yesterday on Sunday, Saudi Arabia reaffirmed the production cuts. We talked about this 2 weeks ago. 2 weeks ago, the energy minister of Saudi Arabia said, if you're short oil, you're going to get crushed. He didn't quite say that, but he said something pretty close to that. So anyways, so knowing that maybe, okay, you would have that in your analysis and a triple bottom. might be interesting to you, knowing that Saudi Arabia probably wants oil prices to go up. So why fight them? Buy at the bottom. I did cover this at FX Bootcamp in great detail, so I'll just leave it at that. But now we have a gap. The way that you trade a gap is nature abhors a vacuum. So typically it starts up. You start here, you fill the gap, and then you continue mission. Textbook play. Now, somebody often will say, I'm filling the gap from 3 weeks ago. No, son, it doesn't work that way. No. Like we're talking like hours, not weeks. Okay. So anyways, that opened up high, filled, and then continue mission. That's how I've always traded it and all that kind of stuff. So anyways, it's in the training course somewhere, but my new book, Bulls versus Bears, will also cover gap filling. I brainstormed over the weekend because that's what the Wayne do. I think I have 63 trading strategies I'm going to cover. Cool. Let's pull up the QB because that's what we're here for. Just quickly look at oil. See what oil says. Yeah, neutral, because it's not listening to the energy minister of Saudi Arabia. It's looking at economic data, which it's certainly not bad information, but it's not really looking at supply and demand. I think really, and it's not that I think this, it's not looking at supply at all. Now, I do envision QuantBox doing it. Oh, I do. I could show you something. I can show you a few things. Yeah, we can get that data, and I do expect to be able to provide that to you. We're already reinvesting into that. But it is trying to understand demand. Okay. And so right now it's like, well, we're not in recession, but it kind of feels like we're going to be. And this is how the market feels too, right? Yeah. So you're like, yeah, so interest rate. But then you add a little sprinkle of human intelligence. We say, well, the people that are major suppliers of this commodity are cutting back supply. Now, they might be cutting back supply because they expect demand to fall, but nonetheless, then you still get a new equilibrium. Less supply, higher price. So that's the tug of war. Okay. Remember, quantitative analysis is a lot, and QuantBox is automating. You got to think of it as not a decision maker for you. It automates part of your job. Okay. So in this case, it's automating the aggregate of economic data and then doing comparative analysis, right, amongst asset classes. But it's not listening to the energy minister of Saudi Arabia and going that next step. You still need to have some alpha. Okay. And yes, it looks at daily trends, right? But it doesn't put you into a trade either, right? Even if the technical trend is down on the daily, it doesn't mean today is the right day to buy or sell. So you still have a lot of work to do. So anyway, buying a dip could be your strategy. Another way of looking at this one little thing is you could do it that way. But really, you're trying to kick it off that 21 and the gap has filled. So very often, whatever created the gap up continues up. Okay. And that's how you want to look at this, not just this one piece of news, all gaps. Whatever created the gap, whatever happened over the weekend to make this pop is still around. So on some profit taking, price comes down, but then the new people that were not in it on Friday go, oh my God, look at the giant, Look at the giant move in oil. So then new traders come in and they buy. And then we continue mission. Whatever made this up continues to push it up as new money comes back into the market. So that's how you want to look at it. Fill the gap, continue mission. With that being said, I hope you have a wonderful trading day. Thank you for being a subscriber of QuantBox. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful day. Cheers.